Are you thinking about taking out a business loan and you're not sure what type of loan to take out for your business at what time? Great. Well, this video is going to help out with that. So the reality is that there's a whole lot of different types of loans, and not every single type of loan is built for every use case, and not every use case is built for every business. So I'm going to break down the different types of debt, help break down sort of the difference between each one, and help you realize that not all debt is created equal, but if leveraged the right way, it can be a really, really powerful tool to help you think about scaling your business. So first, term loans. Term loans are a pretty popular type of loan where you borrow a fixed amount and you pay it over a certain period of time, typically in regular installments with interest. They can be secured or unsecured and come at different rates over time. And so we find term loans are, pretty good and useful for different types of use cases, such as equipment and real estate and general working capital. But if you potentially are sort of uncertain about your cash flows, it might not necessarily be the right fit for you. And the regular payments that are at a fixed amount could potentially put a strain on your business. Next, lines of credit. Lines of credit is kind of like a revolving credit card account where businesses can sort of borrow a certain amount of funds at a predetermined limit as needed, and interest is only charged on a certain amount borrowed. Lines of credit are really, really good for covering short-term expenses or dealing with seasonality or managing your cash flow fluctuations. And it sort of allows you to sort of pull on it when you need it rather than just taking on a certain amount of debt, even if you're not sure whether you need the whole thing or not. Next, SBA loans. So SBA loans are government-backed loans. Usually they offer pretty affordable terms and longer repayment periods, making them attractive for businesses that may not qualify for traditional institutions. One thing about SBA loans is that they do typically take a little bit longer to acquire, and they often require pretty extensive documentation. So think about that when you're applying. But they can be really, really good for working capital, purchasing equipment, or even acquiring real estate. So fourth, equipment financing. Rather than spend all your cash to buy that new piece of equipment for your business, it's often better to get it financed, right? So they're typically in fixed terms, flexible repayments, and it enables you to conserve working capital rather than just taking a bunch of cash out of your bank account to buy that new piece of equipment. And then fifth, invoice financing. So, when you have sort of outstanding accounts receivable or a bill that hasn't been paid yet, but will be paid by a partner of yours or a customer over a certain period of time, you can actually get that financed using the invoice as collateral. Typically, the way it works is that lenders will advance you a certain percentage of the total outstanding invoice value. That could be 75%, that could be 95%. And then the total amount would be repaid once that bill is settled. Often invoice financing helps businesses improve their cash flows by giving you the cash up front so that you would be able to really free up that growth within your business and continue to scale and leveraging the accounts receivable that you already have within your business. And so, typically with invoice financing, it might be more expensive than another certain type of loan, but it allows for the invoice itself to be the security for that loan. If you're interested in learning more about the different types of loans and how to potentially make them work for you and your business, check out Bags. We're here to help. Thanks.